Hey everybody, this is James with WSTrades.com. I wanted to talk about call options. Some of you are trying to get into options trading, or you want to learn a little more about what a call option is or what options trading is. I wanted to give some of those details here and give you a better idea of like what it means to go out and trade a call option, whether you want to buy one or sell one, how it could be profitable for you, and how it could be a losing trade for you. So I have my favorite ticker here pulled up, Space or Virgin Galactic. So I'm here on the trading tab here in Thinkorswim, and you see a bunch of different expiration dates. So that's one important component of options contracts is the expiration date. So I've been putting a lot of stuff on for November 19th right now, so I'm going to expand that down. You see a lot of stuff here. I've got options Greeks pulled up here. I'm not going to cover that right now, but the main other component here is the strike price. So you can see in this column right here, you got a bunch of different strike prices. So pretty much what an options contract is you are agreeing to buy or sell a particular stock, 100 shares of it per single contract at a particular price on a particular date. So it's really a speculative way of trading 100 shares of stock. So on the left side here, you have all of the call options, and on the right side here, you have all of the put options. So I'm going to focus over here on the left side. Space is trading around $26 as of market close today. So I'm just going to use this 30 call option here as an example. You can see the bid and ask here, and you can see a mid price probably around $2.01 or $2.02. And when you think of it, that's really around $200 because it's 100 shares. So if you were to sell this thing for $2, times it by 100 shares, you're actually going to sell that contract for $200. So I want to kind of illustrate this a little bit here. Here's that 30 call option contract here that expires November 19th. So that's one important component there is that strike price of 30. Another one, what type of contract is it? Is it a call or a put? And then that expiration date. Here's kind of the price of where the stock is trading right now. And let's just say this is the price graph right here of kind of how the stock has been moving. So let's say you want to buy this call option contract, and let's just say it is worth $2, or that's the mid price right now. That's what you can get filled at. So let's just say you want to buy that 30 call. So as a buyer of the call, you're going to spend that $200 to own the contract. So before November 19th, you want Space to make a move in the upward direction. Because if Space makes a move in the upward direction and gets closer to this 30 level here, or closer to being in the money, it's going to become more valuable. Let's say Space goes on a crazy run and goes to $60. That was a recent high that it tested before November 19th, or even on November 19th. If you think about it, if Space is trading at $60 and you have the ability to buy Space at $30, that's a difference of $30 in price times 100 shares. So that's a difference of $3,000. So you can see how that options contract becomes valuable for you if you're a buyer of the contract. Now, if November 19th hits and Space does not make it above $30, there's going to be no intrinsic value in the contract because it is expiration and the price did not go above. So let's just say Space made it to only $29 a share. If that contract gives you the right to buy it at $30 a share, you see that makes no sense. So it's worthless. But if the price made it above and you had the ability to buy at $30 a share, then it's profitable. So if you go on the other side here and you look at selling the 30 call that expires November 19th, you're on the flip side. You want that price of Space to stay below $30. You don't want it to make a move higher. If it does make that move higher, you see you're on the flip side. Let's just say Space blasts off at some point before November 19th and hits $60. You can see that contract is going to be worth $3,000 of intrinsic value pretty much, but probably worth a little more because there's still time. left before expiration. If it's at November 19th and the market is closed and it's at expiration and space closed at $60, then that thing is going to be straight up worth $3,000. There'll be a $30 difference between the strike price of the call contract and then the actual price of the underlying stock. So, you can kind of see as the buyer, you've got to fork over that $200 up front to have the chance to make money if this thing moves to the upside. And as the seller, you collect that $200 up front in hopes that space stays pretty flat or dies off. And then, if November 19th hits and space doesn't make the move that it needs to make, you're just going to keep that $200. You never have to give that $200 back. As the seller, if you sold this contract for $200 and space goes to $1 million a share, you still keep that $200 that you collected up front. Of course, that'd be a very bad deal for you if space went to the moon, because you're going to see that you're going to be down big on the trade. But, you just take that premium up front and you can keep, you keep that premium no matter what happens with the price of the underlying stock. And then if you're the buyer of that contract, you fork that $200 over. If the stock price makes a move in your favor, then that contract can be much more valuable. And you can dump that contract before expiration, or you can hold through to expiration. If space made it above $30 and November 19th rolls around, you can hold that contract, let it go through to expiration, and then you'll actually be buying those shares at $30 a share. If the price finished at 60 and you're buying at 30, you only have to pay $3,000 for the shares, but bam, when you get the shares, they're worth $6,000. So you see how valuable that is for you as the buyer of the contract. So I'll upload some other videos. I'll talk about some other things a little more in depth, like in the money, out of the money, exercise assignment, some other things like that. But I just wanted to kind of go over the basics and cover a little bit of how these call options contracts work and how they can be profitable for you, how they could be at a loss for you depending on if you're buying the contracts or you're selling the contracts. So I hope this video provided a little bit of that information and gave you a little bit of a better idea of what it means to trade these call option contracts. Please like this video. Please also subscribe to the channel. If you're not subscribed, hit that notification bell. Appreciate you guys for taking the time to watch this. Talk to you soon.